So in this session, we're going to discuss mainly some of the major concepts around MBA finance interviews and what broadly covers them, and how do we look at interpreting some of those numbers and answering some of those in the context of actual interviews. Obviously, this is not an exhaustive list of questions that are there that can be asked for a finance interview, but this is just a starting point. They indicate what kind of questions can come, but it doesn't mean this is the entire list of questions that exists, obviously. And so it would be a good idea if you could kind of go ahead and read a little bit more on the topics that we are going to discuss here. We would be using a wide variety of topics here, and might keep picking and choosing specific areas of finance which we think are important over the course of the next few minutes, and try and understand that as we go along. So the first key point or data about corporate finance that comes and gets asked a lot about in interviews is this entire concept of capital budgeting, and these terms called NPV, net present value, and internal rate of return, IRR. It's a very simple concept, but tends to get overlooked and not explained a lot of times in proper detail, but forms the cornerstone of a lot of the financial theory that follows in subsequent sessions or subsequent years as you go along. So what do we mean by NPV? As the term stands, net present value. It kind of basically says, if I'm going to get a series of cash flows next year and I expect a certain amount of return from that, how much should I pay for it today? So simplistically put, if you're going to get 110 next year and you want a 10% return from it, how much should you pay today for it? And we all know intuitively the answer is 100, because we just took 110 and found what is the value of 110 today by discounting it to today. If someone had said you want a 10% return and you're going to get 121 at the end of second year, and you want a 10% return which is kind of compounded, so you will again do the same exercise, right? Just that this time you raise it to the power 2 because this is the second year, and you again will get 100 as the value based on that. Now, note that you could just generically put this as a cash flow at a certain year n, and then divide it by a rate of your required return and raise it to the power n. That's going to be the present value of any cash flow. If there is a series of cash flows, you kind of add all of that up and find out whether you should be paying for a project or not. So just hypothetically speaking, if a project cost is 150 and you've paid 150 in year 0, and let's say you're going to get 100 next year, 100 next year, and 200 the year after that, should you take the project based on a certain rate of return expectation? Also, if let's say the project cost is 150, but you're going to get 100 and 50 and 50. Now, in mathematical terms, you're paying 150, but you're getting 200. But remember, these numbers are essentially coming at a later point of time. So the value of these numbers is not the same as today. Because if the money comes to you today, you could use that in the bank, you could put that in the bank and get interest on that. But if the money comes after a year, then you have to fund it for that period. So essentially, earlier the money comes, the better it is. And consequently, 100, 50, 50 is not the same as a 50, 100, 50. Because when you discount them, you will realize that the first one is slightly better because you're getting more money earlier. Correct? So that's the broad concept of NPV. Now, if you have an outflow followed by a series of inflows, which is usually the way projects work, right? Then, and you've found, let's say, the present value of all these inflows, and when you compare this, right? So inflows are plus, outflow is minus. If this number is greater than 0, that's the net present value being greater than 0, which means value is getting created. If value is getting created, you accept the project. So broadly, if you pay something and the present value of all that follows after that is positive, when you account for that payment, then you accept the project. But if you pay something, like let's say you pay 200, but you're getting a present value which is less than 200, then you essentially reject the project. If the value is less than 0, then you reject the project because this does not add value to the overall thing. Obviously, in real life, there are nuances that play out. So we are not certain about what these cash flows would be with 100% degree of certainty, because we could have a scenario where we're projecting these cash flows. In fact, this basic premise of finding net present value is what will extend itself into more intricate concepts around how do you value stocks or bonds as you go along in financial valuation, right? So generically put, you have a cash flow outflow at this point, and then you have some inflows that is going to come in at various points of time. Let's say there's a 4-year project that is there. You find the present value of all of these at a certain rate of discount that you believe is correct, or you want to kind of make that return, and you add all of this up. If this value, which is the total net present value, is greater than 0, then you accept the project. If it is less than 0, you reject the project. So that's the contour of NPV as it comes along, right? Now, there's another concept as you kind of move ahead, and that concept is something called as internal rate of return. Note that if you keep changing this R, there will be one particular R, there will be one R at which the NPV will become 0, right? So if you keep increasing, let's say the NPV is positive, the NPV is, let's say, positive. If you keep increasing the R, at some point it will turn negative. And there would be a plot in between where that would become 0. There would be a point in between where that would become 0. That's your IRR. So think about it. Let's say you are looking at the NPV on this side, and you're looking at the rate of discounting R here. At some point of time, let's say the NPV is positive here. As you keep increasing the R, the NPV will keep falling, right? And at some point of time, it'll turn negative, right? It'll turn negative. This point here is what your IRR is. Now, how do you assert an IRR? Let's assume for a certain set of projects, the IRR is 12%. So at any rate of return that you expect less than 12%, the project is positive or profitable. At any rate of return that you expect greater than 12%, the project is negative. You don't want to take it because NPV will turn negative, correct? So what does an IRR basically tell you? When you look at an IRR broadly, then in that perspective, you will realize that this is effectively the maximum rate of borrowing money. Slightly different counterintuitive way of looking at it. And if you look at this in example, this broadly would mean that why would you want a 12% return for a particular project? Is because you've borrowed at less than 12%. And so you want a slightly better return from the project that covers your cost of borrowing. So 12% is the maximum rate at which you can borrow this. If you try and extend this beyond that, let's say the bank is giving you money at 13%, then you should not accept the project. So now the same contour plays out. Let's list it down in terms of our broad understanding. If your rate of return expected is, let's say, greater than the IRR, that would imply that your NPV would be less than 0, right? If you expect a return of 13% from the project, but the IRR is going to be 12%, then your NPV is going to be less than 0, in which case you will end up rejecting the project, correct? So that's the broad premise of the concept. But if your rate of return expected is less than the IRR, that would mean that NPV for this project is greater than 0, in which case you accept the project. So both of them kind of give you similar scenarios, just that in real life, there's a slight difference when you use them, right? So theoretically, one is being derived from the other. And so consequently, when you accept a project using NPV, most of the times you will also accept the project using the IRR, but that may not really be true in practical sense when you're looking at markets and when you're looking at projects in real life. Now think about NPV. What is NPV saying? Let's say you have two projects, project A and B, and all you are saying is that the absolute value of NPV for one of them is plus 1 million, right? And the other one is plus 10 million. So which one should you accept? If you look at this broadly, obviously the bigger the NPV, bigger the net present value, you should accept that. But that also assumes that you have put all the money into this project, right? What if once you accept this project, then tomorrow more projects are coming up, right? So that's something that you have to keep in mind in real life. That's not the same as just saying that I accept a project with the highest NPV that is available. The second is, let's say you have an IRR kind of a scenario where there's a project A and a project B, and IRR of project A is 12%, but that of project B is 18%. Which one should you accept? Obviously, if you accept the higher IRR project, then that would mean that you can borrow at a higher cost and still be profitable. So you would want to go with a project that gives you that cushion that tomorrow, if the borrowing cost goes up and your expected rate of return increases, you still do not breach this condition. Correct? So you want to pick the higher IRR project, but there is a specific case where one of them will apply, right? So if you look at a company like Reliance, right now, Reliance has basically no scarcity of funds. And when I say Reliance, it could be Reliance, it could be Infosys, it could be TCS. They want to do a project, they will get funds for it, right? If there is no scarcity of funds, you always have funds availability, then you want to choose the project that gives you the highest value, right? Because if there is another project that comes up tomorrow, you will still get money for it. In that case, the firm should be using NPV. If there is no scarcity of funds, you should be using NPV. But if you're a smallish firm, if you're a small firm which has a limited set of resources, right? You have limited access to resources or money or capital. In this particular case, you want to capture something that gives you the maximum bang for the buck, maximum bang for the money that you have, most value creating opportunity. And in that case, IRR fits the bill. So if we want to summarize broadly, while your IRR or NPV rules in a lot of the cases will give similar numbers, if you have scarcity, or let's say if you have no scarcity of funds, you have always an availability of money, then NPV serves better because this maximizes absolute value. Why will you choose a smaller project if there's no dearth of money? Just choose the bigger one which gives you $10 million rather than $1 million, right? But if you have a scarcity of funds, if you have a scenario where the funds are kind of scarce, then at that point of time, you want to choose something that is the most value accretive, or the one where your return is highest. Return on the money that you have put in is the highest. And so you choose the higher IRR project. And that's a subtle difference. So a smaller firm is more likely to pay more attention to IRR. A larger firm is more likely to pay attention to NPV. And that's the broader contour of what we define when we use NPV versus IRR. Let's move on to the next topic. When a company raises money, just extending from that topic, how do you find the R, the rate of return that the company needs? Now, the company can raise money in the form of either debt or equity. We all know that broadly there is a precedence of payment in terms of debt and equity. So if there is payment coming from the company, the first people to be get paid will be the debt guys. And then if something is left, that goes to the equity guys. Think of your PNL. From your earnings before interest and tax, you first subtract interest. And then if something is left, you pay tax, and then you get profit after tax. So the money that goes to the shareholders is only after you have already paid the interest once that is gone. Correct? So logically, the risk in debt for the debt holder from the perspective of the person who's giving money is less than the risk in equity. The equity guy is always going to get paid after the debt guy. So whenever you do any kind of calculation, you will have to realize that the cost of debt is always going to be lesser than the cost of equity, because the debt risk perception is lesser. The risk in debt, if you look at the risk in debt, this is lesser than the risk in equity for the provider of the money, right? And so consequently, if I am a bank and I'm giving you a loan versus I'm a bank who's putting equity in your company, buying shares in your company, somehow taking a part in the profitability in your company, then I am looking at a scenario where practically we are saying that the risk of debt has to always be lesser than risk of equity, and so consequently I'm always going to look at a lower return when I'm looking at cost of debt versus cost of equity. So for a company, right, as per the practical reality, debt is a cheaper source of fund. Debt is a cheaper source of funds. Now, why is that important? Is because technically some of the companies, like let's say an Infosys or an Apple, don't have any debt on their books. And if you take some debt, that's going to be useful. Think about it. Infosys sits with about 25,000 crore of cash. Whose money is this? This money is the equity holders' money. Now, equity holders are expecting a certain amount of return on equity, which is basically the cost of equity for Infosys. So cost of equity for Infosys may be 12 to 13%. If you invest in the equity stock of Infosys, you would probably expect that kind of a return. Cost of debt will always be lesser. It has to be less than that. So maybe that's going to be about 8%. Now, why wouldn't the company repay this money to shareholders and raise some money as debt? That's the first question that comes to you. And what you'll realize is that if you do that, that's a good idea because that reduces your overall cost. While there is no explicit payment that you have to do to the equity guy on a mandatory basis, over a period of time, the equity guys will expect a 12 to 13% return. If you're not getting this 12 to 13% return, then the equity guys will not be happy. And so the company is not going to make money or get more money in the longer run. It's going to find it difficult to get more money in the longer run. So this is something that we have to be very, very aware and clear about, that whenever you do any kind of calculation, mathematically, if it is throwing a scenario that cost of debt is lesser than cost of equity, then is greater than cost of equity, then that's incorrect. The math around that is incorrect. You have to ignore that math or correct that math as you go along. So that's an important data point that exists. Now, which brings us to the next conceptual questions, that if it is cheaper, then why don't we have 100% debt? Company should have 100% debt and 0% equity, because let's say cost of debt is 8% and cost of equity is 15%, then why would you not want 100% debt in that context, right? So the answer to that is essentially, so if you were to take a weighted average cost of capital, so let's say this company had 50% debt and 50% equity, then the cost would have been 50% into 8%, that's 4%, plus 50 into 15, that's 7.5%. So that gives you 11.5%. My question is, why not take this to 100, right? And that's because the rates that you see here are not static, but they are dynamic rates. So as you keep adding debt, what is going to happen is the cost of debt is going to go up. And remember, cost of equity is always greater than cost of debt. So that will also keep going up as you go along in this entire scenario. That's a logical flow of this entire scenario that's going to play out. So how does it work for companies? Always remember that in a company's capital structure, if this is my debt on the books or debt to equity on the books, then at some point of time, if I have zero debt, I will have a certain cost of equity, right? That's the cost at which I'm raising money. If I keep, so this is my cost of money, right? I'm not using fancy terms here. If I raise 100% equity, the equity guy will be expecting 12 to 15% return. That's what you expect from the stock market, right? But as you keep starting to raise debt, the cost goes down first. That's because debt is cheaper and you're utilizing your resources better till the time it reaches a certain point, which is your best point of the company's optimal capital operation. And then this starts increasing further. So maybe at a 20% debt, 80% equity in certain cases of companies, or maybe at 15 and 85 or 25, 75 is where you reach the sweet spot in terms of your lowest cost of capital or money that you're raising. But then at some point of time, this is going to increase and go further. And that is going to create a little bit of a challenge as you look at it. So that's why companies don't use only debt, because even though it is cheap, it is not a static source of income that is of funding that is available. The source will keep increasing its cost as you keep raising more debt. Think about it. If you go to a bank and say, I want 100 crore, they'll put a certain rate. But if you increase that to 200 crore, the rate will go up. And then next day you go, the rate will go up further. And then the next day, the rate will go up further and further and further as you go along, right? Let's understand the next concept now. So we did talk about this cost of equity. Now, cost of equity is calculated by a particular method called capital asset pricing model. Again, without going into the significant nitty-gritties of it, it basically says that the minimum amount of money that you can get without taking any risk is the risk-free rate, right? Then from there, if you want to invest in the equity markets, if you are investing in, let's say, the markets, then you should get the market return, which is RM. So how do I reach there? I do plus RM minus RF, right? If I solve for this, I'm going to get the overall value that I'm going to get, correct? So RF plus RM minus RF, if I invest in the market as a whole. Now let's assume that I'm investing in a particular stock. So when I'm investing in a stock, I have to add the stock specific risk. This stock specific risk, which you cannot get away from, is going to be called as the beta. So you scale up this market return using this parameter called beta. Now, a simple understanding of what is beta is, if beta of a stock is 1.2 against, let's say, the market, let's take the argument of something like a company like Hindalco, which is an aluminum company, and I take Nifty as the index. If beta of Hindalco is, argument's sake, let's say 1.2, and I don't know what the number is, but let's assume 1.2, what it means is that if Nifty goes up 10%, it is expected that Hindalco will go up 12%. And if Nifty goes down 10%, it is expected that Hindalco will go down 12%. So in a way, beta is telling you how many times the stock will move when compared to the index or the market, right? Beta is, so the stock moves beta times the market. And if you actually kind of contemplate it, it looks like a linear equation where you're saying y is equals to mx plus c. That's what we studied in maths, where y moves m times x. So the stock moves beta times market. So this slope that you are calculating in the returns between Hindalco or Nifty or Infosys and BSE 500, whatever index you choose, that is basically what is called your beta, right? Now the difference between beta and standard deviation. Standard deviation is a measure of the total risk of a company or a portfolio, which means when you look at buying a particular stock, the overall risk that you take is called as standard deviation, right? Now, you could, however, reduce that risk by using this concept called diversification. So if I buy the stock of Maruti, I am taking the entire risk of, let's say, steel prices. If steel prices go up, Maruti's input prices go up and there's a problem. But what if I buy the stock of Tata Steel along with that? Now if steel prices go up, then Tata Steel goes up, but Maruti goes down, and vice versa, right? So I have kind of, by adding more stocks to the portfolio, reduced the risk of the portfolio. Beta is that risk that cannot be reduced any further. So in the context of a stock, the risk can be identified as systematic risk and something called as unsystematic risk. The unsystematic risk could be diversified away by adding more securities to the portfolio. This risk is given as standard deviation, and only the systematic risk, which cannot be diversified away, it assumes that if you add this stock to the portfolio, it is going to add that risk, that's given as beta, right? Now, beyond the jargon, how do you calculate beta? So if you look at this slope that you have to calculate, let's go to an Excel file and try and calculate beta for a particular company. So what you see here on the screen is is the price of Infosys for the last 3 years and the price of BSE 500 index for the last 3 years, we are saying the stock moves beta times the index. So you have to first find the returns. How do I find returns? Return is the next day value minus the previous day value divided by the previous day value. And that's my return for Infosys. I can calculate the same for BSE 500. I can just double click it here, and I'll get the return for all the days that are available till 31st of July 2018. The daily returns of these two companies are available, correct? Now recall that we are saying that beta is nothing but the slope of that line that I'm creating between INFI and BSE, right? In a sense, what I'm doing is, if you look at this calculation of beta, I have taken a plot between INFI and the market, and all I'm saying is that on any given day there is a certain INFI return and there is a certain market return, and I just plot all of them. Once we plot all of them, the line that describes this the best is the linear regression. The slope of that line is what's going to give me the beta. So how do I find that? I use a function called slope. When you use a function called slope and open the arguments of slope, it says known y's. Y is equals to mx plus c. Stock is equals to beta times market. So y is the stock return. Select all of those. Then go to the next one. Beta is essentially going to be the market returns. Select all of those. And when you click OK, you get the beta as 0.62, right? So that's basically the function that you can use. You can use slope to identify how do you get the beta. There's another formula for beta which you can use, and you'll still get the same answer if you use that formula for beta, but we'll not get into that formula in this session at this point of time. So this tells you that the stock of Infosys is likely to move 0.6 times the underlying market. So it's less volatile as compared to the market, very loosely put. If the market goes up 10%, the stock of INFI is expected to go up 6.2%. That's the contour of how you look at the INFI beta, right? So that's how you calculate beta. But interestingly, what happens if the stock is not listed, right? We have all these IPOs coming in. Let's assume DMart comes with an IPO. Now there is no price available. So when I'm valuing it, remember I need to use this in the equation. This will give me the rate at which I will discount the cash flows to find out if I should invest in this, right? I can extend the NPV concept to investing in DMart. That's like a project. I'm paying some money today and I'm going to get something in return. So I need a rate of return. That rate of return requires a beta, but that beta was using historical values. It was not available in this case because now it's not listed. We are doing an initial public offering of DMart. So in this particular case, you have this concept of levered and unlevered beta that you apply. When you find the beta of a stock from the market, you're likely to find the beta of the company that includes the components of its debt, right? So let's say you look at companies that are similar like Future Retail, and you look at maybe another listed company like a V-Mart that's available, and maybe another one like a Trent, which is Tata Group essentially. And now you look at the betas of all of these three, individually calculate the beta. These betas assume a certain debt equity ratio of these companies, correct? Now, first you take the beta of Future Retail and do what is called as unlevering it. So the basic methodology is you divide it by the debt by equity ratio of Future Retail, and a small adjustment because that debt gives you a tax shield, you do a 1 minus t. This is your unlevered beta for Future Retail. Similarly, you find it for V-Mart and for Trent. What does unlevered beta mean? It assumes that if the company had no debt, what would the risk have been, right? That's my unlevered beta. I take that unlevered beta and basically look at those things. Once I get the unlevered beta for all three of these, then basically we are looking at taking beta 1, beta 2, beta 3. I can take an average. That's the average of the sectoral unlevered betas. And then I can relever it So I take the beta average, assuming zero debt, and then I multiply it with 1 by debt equity of DMart. Of course, 1 minus T comes here as well. But broadly, that's the premise. I first take down the beta and strip it down to a point where I assume there is no debt for the company. So I'm removing debt specific things. See, I can directly take the average also, but what if Future Retail's debt to equity is 2, Trent's debt to equity is 3, and DMart's debt to equity is 1? Now they don't share the same risk, right? And if I take a simple average, it assumes that the average debt equity of DMart is also the same, but that's not true in real life. So it's important that we are looking at this overall contour and we understand what is it that these numbers are going to look like. And based on that, we kind of find the unlevered beta and levered beta. This method of calculation is something called as fundamental beta calculation. You can read up a little bit on this. Sometimes you get questions on this, but it's a slightly more complicated topic as against a simple beta where the understanding and calculation might be a hot topic that gets asked. You get a lot of questions around the concept of PNL and cash flows. Now there are three financial statements: PNL, cash flow, and balance sheet. And a lot of us tend to pay undue importance to PNL. In fact, the entire media around us talks too much about the PNL as compared to, let's say, the cash flows. And the problem with that is PNL follows what is called as the accrual principles, whereas cash flow is basically on an actual basis. And sometimes companies use this premise to kind of fool us. In fact, PNL is easy to kind of move around a little bit because of this accrual scenario. Take an example. A company whose numbers between 2008, 9, and 10 are given to us. We have the balance sheet, we have the PNL. If you look at the PNL for 2008, 9, and 10, very clearly the sales of this company are the highest and the operating profit versus the net profit is the highest in 2008. So that looks to be the best year that is available, right? But if you dig a little bit deeper, you also find that in 2008, there is one more number that is a little bit odd. And that number is this number called sundry debtors. What is debtors? This is nothing but receivables. Every year, whatever you sold, roughly about 20% of that was outstanding as receivables. But in this particular year, 50% is outstanding as receivable, right? So why is this happening? Is because the company chooses to sell some stuff to a group company, right? To a group company. And once they do sell it to a group company, technically, legally, this is allowed. What is a group company? A group company is in which the company does not have a stake. It is a related party, maybe a brother of the promoter who owns this company. So this particular company is DLF. What DLF did was they sold 5,000 crore worth of apartments to another company called DLF Assets, right? So nothing wrong in it. Factually correct transaction, legally allowed transaction. The only problem is the money did not come in. So no cash flow. But because PNL is accrual, you can account for the costs, you can account for the profits because of that. So that way the profits get boosted. The problem is the money is only going to come when DLF Assets is able to sell the flats, correct? And how is that different from DLF actually themselves selling the flats? And if it is not different, then you would perceive that this is some sort of an example where you're trying to probably book revenues a little bit early. And you can do that is because we are paying too much attention to the PNL. It's not necessary that the PNL is going to work at all points of time. It's not necessary that the PNL basically shows this entire story at all points of time when you're looking at it. And so it's important to go beyond the PNL and look at the cash flow and balance sheet. In all probability, these two are the more important statements that you're going to look at. PNL is the less important one. It's what the company wants to show you is what they represent in the PNL, but not necessarily what is the actual picture. And it's possible to kind of move the PNL numbers up or down. So always remember that the cash flow data point is a more important data point for a particular company that you're looking at, right? So that's about PNLs and cash flows as you look at them. Next, we move on to this topic called working capital. Now, we've all read that working capital is current assets minus current liabilities. and I'm going to take a little bit of quick discussion around this as you go along. So working capital is a concept that is a little bit less understood because we are taught that current assets should be greater than current liabilities, right? That's what we are taught in this ratio called current assets by current liabilities. Now, in real life, what are current assets? Think about it. All your current assets are receivables, inventory, and so on and so forth. Your current liabilities are things like payables. Now, if you're running a business, would you want receivables or not? Would you want your customer to pay now or after 6 months? Most of us would want our customer to pay right now. So we want zero receivables. Most of us would want our not to keep too much inventory. So we would ideally, if it doesn't impact things too much, we want zero inventory. But most of us would want to pay our suppliers after a point of time. So we want high payables. Now, when you run the business, it is exactly opposite in terms of the intuitiveness that we are saying that CA minus CL should be greater than zero, or that this ratio has to be greater than 1, correct? Obviously, we've ignored something here. We ignored the cash component here, and it's important to dig deeper on how do you calculate working capital and understand that. But do remember that current assets are assets that basically block cash in the business. If I sell something and do not receive the money, that receivable is blocking the cash in my business. If I buy inventory that is not getting sold, that is blocking the cash in my business, correct? Payables or current liabilities, on the other hand, sort of release cash. If I have not used this cash elsewhere, this is going to get used in my business somewhere, and it allows me to use that cash elsewhere, right? So a lot of the companies actually work with negative working capital. Negative working capital, in a sense, is a desirable state. And if you look at names of companies that would be using this, companies like Maruti, Eicher Motors, Britannia, HUL, Flipkart, Amazon, Ultratech Cement, Idea Cellular, all of them basically work with negative working capital scenario. Fairly successful companies continuing to do successful business, but keep negative working capital because they don't want to fund their business using these after having some assets that are locked up here. Now, do remember always that when you're calculating this formula, try and calculate it using non-cash current assets minus current liabilities. That's an important metric that you need to remember. Now, when I say negative working capital is desirable, do note that this is by a choice. So I would want my working capital to be negative, but it is quite possible that it is turning from positive to negative very quickly. And that's because my payables are just spiking up because I don't have money to pay. Remember Kingfisher? This is a survival issue. This is a problem for the company because in these particular cases, if there is a significantly quick movement from positive to negative, it signifies that the company could be facing a serious problem in terms of paying money in the first place, right? When you look at negative turning to positive, that's like a company that had zero receivables has starting to have receivables, or suppliers are asking money faster, or the company has started keeping some inventory. That's also a slightly negative scenario. And that is important for us to understand that in terms of a broad working capital understanding, it is extremely imperative that you look at a stable working capital. So your choice of order from the business perspective is negative, but if not negative, then stable, which is either negative or positive. So you want a stable working capital because if you have a stable working capital, you can predict what is going to be your sales. You can predict what is going to be your receivables based on that. Do remember that if working capital requirement goes up, which means let's say receivables go up. If receivables go up, then non-cash CA minus CL will go up. If receivable goes up, then that blocks cash, which reduces cash flow. If you reduce the cash flow, the NPV of this business should go down. So while a company having a lot of current assets might be good theoretically, in stock markets, if you look at that company, that situation will not be perceived to be a great situation, right? And that's basically it in terms of our broad discussion here. Obviously, working capital is a vast topic, and you should probably read up a little bit more about working capital as you go along. But that's broadly all that we had to discuss today.